From time to time, I like to talk to Paul Miliotis and Paul Mirren from Msquared Capital, because these guys are actually operating at the coalface of the property market. And so I want to go and see what they're seeing, and that will probably give us some real insights to what's going on in what is described as being a very hot market. Great to see you guys.
Thank you, Peter.
Thank you.
All right, so before we start talking about that, we probably should just, in a nutshell, explain what you guys do. So, Paul,
Yep.
what is Msquared Capital?
So we're a private mortgage fund.
Yeah.
We match basically borrowing opportunities where people borrow money with investors who want to have a stable return on their capital.
Yeah. So Paul, give us a classic example of how you guys actually do your stuff.
In terms of, look, Peter, a borrower will come to us and have a need for finance.
What kind of borrower is it?
Look, the borrower is always for commercial purpose.
Yeah.
So a borrower would come to us with a need for finance. They, for argument's sake, would have a commercial building that they would need to raise some money against.
Right.
They'd come to us, they would request money, we would then do our credit proposal, put it up to our investors who have money that want a return for their money.
Yeah.
And effectively our investors share in the interest that's received for that borrower, and that's how they get their return.
Yeah. And what kind of capital do they have to put up? What kind of collateral do they have to put up to make sure you can get your money back?
Look, we take residential security, commercial and industrial property. We are predominantly Sydney-based lenders. So look, we've found it great in this market because Sydney's been so resilient, and we tend to skew to the residential side because we've seen there's a bit of risk when you're lending against commercial assets, particularly because of COVID.
So if someone had maybe like a $10 million house, for simple numbers, what would the most they could borrow?
Oh, look, depending on the house, but look, we would shy away from going anything over 65%.
So they might get 6.5 mil if the project's good and the house is an easy sell.
That's right.
Okay, right. We get the idea now.
Yep.
All right. So one thing we're hearing about is that the regions are doing really well.
That's right.
So what are you guys seeing in the regions?
Well, look, I think you've the data, recent data in relation to how quickly prices are going up in regional areas are quite astounding. I think last month CoreLogic said it's 1.6%. So we are seeing the largest exodus of internal migration from Sydney and Melbourne going to regional areas because of COVID-19, because they can buy a house for much cheaper, lifestyle purposes. They don't have to go into the offices regularly. So from our perspective, if you are looking to buy a house, and there was a old saying, whether you're buying a house, your own house shouldn't be considered as an investment property. If you're buying your own house, it's your own house. But investors should be a little bit careful from our perspective, and us as fund managers, we're very careful or cautious of lending money against regional areas. Okay,
so therefore, you guys have been here in the past. East Coast was particularly important.
Yep.
Sydney and Melbourne over Brisbane, but you will go to Brisbane if it's a very good deal, I guess. Yeah.
Look,
but regions,
and
is it because in regions it's sometimes hard to actually do a sale and get rid of a property if there's any problem?
I'll go through the logic why regional areas has a lot of volatility in it. See, where you have Sydney and Melbourne and Brisbane, people are centricated to certain areas, to convenience schools, things such as that. If you're going into a regional area and there's a boom in that area, there's unlimited land that you could unlock overnight. Yeah. Developers start building, and you go from high demand, low supply to high supply. And then if that trend that we saw, this short-term trend that people want to go into regional areas right now, turns around because people are needed to go back into the city and back into the office, that could overturn very quickly.
That's a very important point. If people are buying in the regions hoping for capital gain based on what they've seen recently, but that's based on a constant supply. As that supply changes, that potential capital gain could go off the board.
That's right.
Okay, great point. Let's go to the next area. You guys are big in the commercial and industrial space. People come to you because they might have difficulty getting money from banks because they're doing a business type borrowing. So what are you seeing there?
Look, we're seeing a lot of, in the recent past, we've seen a lot of inquiry on all three aspects of that asset class. From our perspective, we think, residential is where we would skew a lot of our investments. We see the residential market, whether it's houses or units, you can argue which one's a better class. We are very happy to take those securities. We think the risk of properties going significantly down in value, particularly in where we're looking in the eastern seaboard, is unlikely. When you're looking at commercial, the government stimulus is stopping. We can see cracks in certain tenancies with commercial property values. They are based on tenancies. So when we're lending and we see a commercial tenant, we have to look really strongly at the tenancy. So we are very, very cautious. Not saying we wouldn't lend against a commercial or an industrial property, but I think you should be a lot more cautious when you're doing so.
Have you lent to somebody who's bought a commercial property and because of coronavirus, they're not quite as a strong borrower because of that?
Yeah, absolutely. It happens. But it's very interesting to note, and we're watching this very, very carefully. So, for example, the inner city apartments, I think the stats came in today, the vacancy rate has actually doubled. Talking to the agents, the values haven't fallen. So is that a sign what's going to happen in the future or not? Same thing with residential property, and I'll go through it a little bit more detail later, but with residential property as well, a lot of investment properties are vacant at the moment in certain pockets of Sydney as well, but the prices haven't fallen as yet. So
is that because a lot of the investors are waiting this out, thinking that, okay, it's not great, I'm not getting Airbnb overseas people, I'm not getting foreign students, but in a year's time I will. So rather than maybe taking a 10 or 15% loss on the purchase price, I'll wait a year.
Well, they're not taking a hit on the price. One of two things are happening. Interest rates are very low, so that's cushioning that shock. Second of all, there's a bank moratorium at the moment. So even if if you call up your bank and you say, look, I don't have a tenant, they can't take any legal action against you. So I think all those elements together has actually provided a very low supply of that, low supply onto the market. So therefore there isn't a downward pressure on it. But not to say as a fund manager and for us to take security over these assets, I'm going to be a bit more cautious. Because even though if I read the headlines of the newspaper and RBA is saying that the house prices could go up by 30% over the next 3 years, I need to look at worst case scenario because the whole system in relation to lending money is to make sure that I preserve your capital.
Industrial's doing well, I presume?
Industrial doing exceptionally well. And the reason why industrial land is doing so well is because obviously there's a demand for that sector, people buying online, but there's not enough land as well. So, if you look at it from a planning perspective, there's only X amount of industrial land across Sydney and Melbourne and Brisbane in certain areas. There's lack of it.
Well, a lot of people watching this program would be interested in your take about houses versus units. You've touched on it already. And I think the question that they're thinking is there really good value out there for people to start looking at home units because of, two things. People moving out of the city, office blocks are relatively empty compared to where they were. What's the take?
Look, CoreLogic, once again, I follow them because they have really good data as well. The difference between the gap between houses and units have never been wider at the moment.
In price growth we're talking about?
Not price growth, it's a difference in value. So the median, the value has not been wider.
So the median price of a home in Sydney compared to a median price of an apartment, biggest gap ever.
It's going, and that trend will probably continue.
But has the gap been created because
houses gone up?
And units have stayed
And units have gone down marginally. I think 0.2%.
So on a relative basis then, Paul, units are attractive.
They will be. We think that units will catch up to houses, but it might take a bit of time. We believe that when the borders open, people will come into Sydney or they'll come into the centres and they're going to rise. So to your point, is it a good time to buy? You'd be arguing there will be buys out there. Rates are low, and we do believe it will catch up and it will follow, but it might take some time.
Well, as Warren Buffett said, and you guys know it, when everyone's greedy, be fearful. When everyone's fearful, be greedy.
That's right. But it's remarkable to see how prices of units hasn't fallen. Same way of the other analogy I gave you with commercial, in the midst of there's less than, overnight we lost 550,000 people in Sydney who needed those dwellings.
Yeah.
So, you know, you had the students, the tourists, all those people have left overnight, and we haven't had net migration as well. So units do really well when net migration will come back. That's my opinion.
Correct me if I'm wrong, and I know you will because you always love to try and find fault with me. To date, you never have.
Never.
But when you guys started in this business, were you worried about the calibre of the apartment buildings, the blocks that were being built then compared to now?
The quality?
Yeah.
Absolutely.
Yeah.
Like unfortunately, we've inherited probably a negative philosophy in relation to building as many dog boxes as quickly as possible. And the consequence of it now is that without the students, they're predominantly empty.
Yeah. And a lot of buyers, I guess, are a bit suspicious of new builds. And I know I've had people on my program saying, well, they're better off even looking at 30-year-old buildings.
Yeah.
They've stood the test of time.
The red bricks.
Yeah, that's right. And you can actually see if there's any potential danger or problem there. But these bigger ones are probably spooking a lot of younger people.
Yeah, and they probably are. But I believe that there's a very significant demand for larger apartments that don't exist. They haven't been built yet. In mostly in Sydney. Brisbane is a different market. They do have some larger apartments traditionally in their planning, but Sydney, in most of the areas, people have not traditionally tried to build a 2-bedroom apartment larger than 85 square metres.
I noticed, and you guys would know the area well, Rosebery, where a lot of apartments have been built in recent times. A lot of those seem pretty big, and I guess they are people who would like to have a home in the eastern suburbs, a house, but they can't get it, so they think, well, let's get a big apartment, everything's walking distance to golf and parks and beaches and stuff like that. But that's the kind of apartment that you think would have capital gain over time?
It should have capital gain over time because the demand for it will increase as things get normal after COVID. So there's a typical type of tenant that will be requiring that type of dwelling, and we just don't have them around at the moment. So I think it will normalise once COVID finishes, but there's still opportunity in the market. You know, for example, in Bondi, who would have thought Bondi, blue chip suburbs, if you have older unrenovated apartments, I've heard from property managers they've been vacant for 6 months. And even if you're
owned by investors, and they're usually rented out for the enormous crowd that goes in our Airbnb style, I guess.
Yeah, and look, even if they're dropping it at $100, $200 a week, less, let's call it 10-15%, they're still not getting enough interest. So that is a remarkable situation. But as I said, even more remarkable, the price haven't gone down on those assets.
The borrower perspective, you know, is there really a good deal flow going on right now?
Look, we are. We're seeing a lot, and there's two reasons that we've analysed why. When the banks are analysing borrowers, they're looking at for PAYG borrowers. I think that are buying residential property. That's the banks are doing well with delivering that.
It's an easy borrow.
When they are coming to the business operators that may have been affected by COVID. The banks typically like historical data. When they look at the data of what happened in COVID, when people have had a bit of a downturn, I think to get their head around how the business is trading now has caused an inflow of borrowers to us.
Yeah. So CBD business, you know, obviously had a bad run for a year.
Well, that's one. But just say, for example, we've had a borrower come to us that said, look, I did get affected significantly during COVID, but now I'm trading better than I did at COVID. I went to the bank, it took them 4 months to assess my deal, and they couldn't see the way I was trading. The way we assess deals is slightly different. We forensically look at their accounts, we forensically look what hits there. So we can verify what they're making now, historically what they're made, and we're talking clients with properties in Manly, in blue chip.
So they're very good collateral.
Very good collateral.
And usually their business would have been made it easy to borrow, but because of coronavirus,
there's been a
bit of a dip, and now they're going.
So and they can't prove to the bank that it's gone up because the banks are quite conservative. They want 12 months worth of trading.
Yeah.
Now we've only come out of lockdown 4 or 5 months, so we took a different opinion. We said, okay, well, give me your current bank statements, and we do an assessment basically on what's going on in the last 2 or 3 months.
Yeah.
A deviation from what the bank can do. They have good security. We look at the character of the individual. We want to see at the worst time when things actually dipped, how do they behave? They keep paying their mortgages and obligations. They did everything they could. So they sold assets. They did everything they could. So, you know, we look at the character of the individual. We look at the assets. We look at the situation. And so we can be a bit more flexible, and we can be a lot quicker as well. We finance it for a 12-month term. If the business goes back to normal, then they can go back to the bank in 12 months, no issue at all. So those are the type of opportunities that we're seeing right now. They're quite unique, and investors are still getting a very good return. So on that particular opportunity, it's above 7% net return to the investor.
And so the borrower was paying about what?
The borrower was paying about 9 on that particular
situation.
situation.
What if they could have got through to the bank and the bank would said yes, what would the bank charge you?
A bank would charge them 3s.
Yeah.
So it's a significant premium for them not to sell all their assets, not to pay stamp duty, not to, you know.
I think one important point there, Peter, as well, historically, the one, I know the deal that Paul's got in his mind, historically this is a bankable client. It's not like sometimes there's a misconception that you go into a mortgage fund and some of them might be doing it, are in high risk. This is a bankable client. You're looking at a security that's based in the middle of, you know, within 20k radius of the city. That's trading businesses turning over, let's use high level, $5 million. You're not talking someone that is in arrears, and that's right.
It's not a startup. It's not a startup business.
So, and that's why you said,
business.
and that's why you said, you know, probably within a year he'll be able to go to the bank and renegotiate.
That's right.
And
so we're there for a period of time.
We want him to go. That's the whole purpose. We want to raise the capital. We want to fix the problem that he has right now.
And he must have a very good business opportunity to be willing to pay 9%. To make sure it happens.
That's
Absolutely.
right.
Yeah.
And so at the moment, in his field or other business operators as well, look, some of the competitors are not doing as tough as what he is, and he has an opportunity to take a bit more market share. So for him, he goes, okay, it's opportunity cost. It's going to cost a little bit more money in finance, but I can actually solve that problem without thinking about it. I can just focus on my business and grow it.
Okay, guys. If people want to know more about your business, what's the website?
www.msqcapital.com.au. But Peter, on that view, anyone that's listening can call us directly. We have no issue with people calling us directly, so we just put it out there.
Paul Milliotis and Paul Mirren from Msquared Capital.
Thank you.